In the final weeks of 2025, something unprecedented happened in the silver market. Physical buyers started offering $10 over spot price, desperate for metal. At the same time, the Shanghai premium hit $6 above Western prices. And the futures curve inverted so hard that traders who've watched this market for decades started asking one question: who knows something we don't? If you think that's just noise, I'm about to show you why the next 12 months could redefine what silver means as an asset class. Hey everyone, today I'm laying out the complete case for why silver in 2026 isn't just another commodity play, it's potentially the most asymmetric opportunity in hard assets right now. And I want to be clear about something up front. This isn't hype, this is pattern recognition. Because what we saw in late 2025 wasn't random, it was the market screaming that something fundamental has shifted. We're going to walk through 5 critical reasons why silver has moved from interesting to strategic. We'll cover the supply deficit that's been building for half a decade. We'll talk about why governments suddenly care about silver stockpiles. We'll decode what futures market backwardation actually means for physical availability. We'll connect central bank policy shifts to precious metals pricing. And we'll examine the kind of volatility that either destroys unprepared traders or rewards those who understand what they're watching. Then at the end, I'm leaving you with 2 questions I genuinely want your perspective on, because the comment section is where we pressure test these ideas in real time. But before we dive deep, do me one favor. If you want analysis that cuts through the noise and gives you frameworks instead of fantasies, hit subscribe. One tap, that's it. Because 2026 is going to move fast, and the critical inflection points won't wait for stragglers. Alright, let's get into it. When you look back at 2025, you see the headlines: record performance, volatility, premiums. But markets don't care about vibes or narratives. They care about outcomes. And the outcome for silver in 2025 forces one unavoidable question. Silver was up approximately 46% in 2025, making it one of the top performing assets of the year. Now that kind of move always triggers the same debate. Was that the blow off top, or was that just the market waking up to reality? Here's what matters. In metals, the biggest moves almost never happen before the crowd notices. They happen after. They happen when retail finally pays attention, when institutions start allocating, when physical buyers realize waiting for a pullback means competing with everyone else who also waited. And what makes silver different from speculative momentum plays is this: it's not just a story, it's a bottleneck. It's a material that gets consumed in real-world applications, fought over by manufacturers, and increasingly treated as strategic by governments. So the question isn't whether silver moved in 2025. The question is whether the conditions that drove that move are resolving or intensifying. And when you look at the actual data, every structural pressure point is still there. In fact, several have gotten worse. That takes us to reason number 1, and this is the foundation everything else builds on. A structural deficit. That's a polite term for an uncomfortable reality. Demand exceeds supply, and the gap is being filled by draining above-ground stockpiles. For roughly 5 years now, silver has been running persistent deficits. The total pull from industrial users and investors has exceeded what mines and recycling operations can deliver. So what happens when you can't produce enough? The market doesn't magically create extra silver. It pulls from inventories. It taps institutional stockpiles. It leans on whatever above-ground metal exists to bridge the gap. But here's the critical part. Stockpiles are not infinite. They're buffers. And buffers shrink. And this is where human behavior enters the equation. When inventories shrink, the remaining holders become more reluctant sellers. They don't want to part with metal at yesterday's price, because scarcity fundamentally changes decision-making. Think about it. In a surplus market, sellers chase buyers. They have to move inventory, so they compete on price. But in a deficit market, buyers chase sellers. The entire dynamic flips. Now the question becomes, what price convinces someone to give up what they have? This creates what I call a ratchet effect. Each wave of demand hits a higher wall. Each depletion of inventory raises the threshold for the next willing seller. And silver has a unique complication that amplifies this dynamic. A massive portion of silver demand is tied to real-world industrial use, electronics, solar panels, medical applications, industrial processes. These aren't discretionary purchases. These are manufacturers who either secure supply or lose output. And losing output is almost always more expensive than paying a premium for silver. If you're a solar panel manufacturer and you can't get silver, you're not producing panels, your factory sits idle, your workers get paid for nothing, Your contracts go unfulfilled. That's far more costly than paying 10% or 20% more for the silver you need. So structural deficits don't just resolve because commentators want them to. They don't disappear because a chart looks extended. They resolve through one of two mechanisms. First, price becomes painful enough to ration demand. Some marginal uses get priced out. Some buyers delay projects. Some applications find substitutes. Second, new supply finally arrives, new mines open, recycling ramps up, production increases, but both of those take time. Opening a mine takes years. Scaling recycling infrastructure takes investment and logistics. And in the meantime, the deficit continues. Now, I want you to understand something about deficit markets. They can run longer than people expect because stockpiles provide a temporary cushion. But when that cushion gets thin, price discovery becomes violent. It's not a smooth adjustment, it's a scramble, and we're seeing signs that the cushion is thinning. Exchange inventories have been trending down, institutional holdings show drawdowns, and most telling, we're seeing premium bids for physical metal that significantly exceed paper pricing. That brings us to the second major driver, and this is where silver stops being just a commodity and starts being treated as strategic infrastructure. In 2025, the United States officially designated silver as a critical mineral. It was added to the critical minerals list. Now that might sound like bureaucratic paperwork, but critical has a very specific meaning in policy circles. It means the government considers supply vital to national interest. It means supply chains are viewed through a security lens. And it means the metal is no longer just an investment or industrial input. It's strategic. And once that designation happens, the playbook changes entirely. Because governments don't behave like retail traders. They don't buy because a chart looks attractive. They buy because they want control, resilience, and domestic security of supply. Alongside the US reclassification, we saw clear signals that Russia has been allocating spending toward precious metals reserves that include silver. Whether that started as speculation or policy, what matters is the direction. Russia is treating silver as reserve relevant. When sovereign entities move into a market, they're not flipping it next quarter. They're removing supply from circulation. They're adding a layer of demand that's sticky, strategic, and long-term. Then there's China. And this is the development that should make everyone pay attention regardless of their views on geopolitics. Starting this month, China moved to tighten controls on silver exports. This is a major producer and consumer essentially saying, we're going to be more careful about what leaves our borders. That's not a casual policy adjustment. That's a strategic posture. And it fits a broader pattern we've been seeing across multiple commodities. Countries want critical inputs at home, not freely flowing across borders when supply gets tight. So let's zoom out for a moment. The US labels silver critical. Russia allocates reserve buying. China restricts exports. Different countries, different motivations, same results. More competition for a metal that's already in structural deficits. And when governments compete for supply, they don't care about cost efficiency the way private buyers do. They care about securing what they need. This creates a second layer of demand that sits underneath everything else. Industrial demand continues. Investment demand continues. And now sovereign demand adds a third leg that removes supply from the open market. Now we get to reason number 3, and this is where market mechanics can turn a tight market into an urgent market. Backward action. Most people never talk about backward action because it sounds technical and trader focused. But the concept is simple, and the implications are massive. In normal markets, futures prices are higher the further out you go. Why? Because if I'm going to receive a commodity 6 months from now instead of today, someone has to store it, insure it, and finance it for those 6 months. Those costs push future prices a little higher. That normal upward sloping curve is called contango. Backwardation is the opposite. The curve flips. Near-term delivery costs more than later delivery. And that inversion means the market is saying, I want the metal now, not later. In late 2025, silver's futures curve pushed into unusually deep backwardation. Near contracts traded at a premium of several dollars compared to later contracts. That's the kind of inversion people associate with historic stress points in commodity markets. Why does this matter? Because backwardation typically reflects one or more of 3 conditions. First, physical supply stress. There's not enough metal readily available to satisfy immediate demand. Second, surging physical demand. Buyers are willing to pay extra to secure supply now rather than wait. Third, breakdown in the usual arbitrage mechanisms that keep pricing smooth. Often, it's a combination of all 3. But here's the real impact. Backwardation creates psychological urgency. When traders and buyers see that inversion, they stop thinking, maybe I'll pick some up later. They start thinking, why are people paying extra to get it right now? What do they know that I don't? And that question creates a feedback loop. If everyone wants physical now, then I want physical now too. It's the same dynamic as a bank run. Most people don't run to the bank because they love running. They run because they see other people running. Now, I'm not here to throw out fantasy price targets and pretend a single chart pattern guarantees a specific outcome. But I do want you to understand what long-term context looks like. People love to reference the old nominal high from 1980 as if it's some magical ceiling silver can't break. But nominal highs ignore decades of inflation. When you adjust that 1980 peak for inflation, it's far higher than most people realize. And technical analysts who study multi-decade base patterns argue that silver has spent years building a massive foundation that could support significantly higher pricing over time. I'm not saying that automatically happens in one calendar year. I'm saying the ceiling many people reference as insurmountable is not as low as they think. And that matters in 2026, because if the market shifts from paper comfort to physical urgency, you get repricing that looks irrational until you remember its scarcity doing the pricing, not opinions. The futures curve is one of the clearest early warning signals that physical availability is getting tight. And in late 2025, that signal was flashing red. Now we get to reason number 4. And this is the factor that quietly feeds every scarce asset rally. Loose monetary policy. In late 2025, the Federal Reserve announced it would stop the runoff of its securities holdings starting December 1st. If you've been following monetary policy, you know that runoff was part of the quantitative tightening phase. Letting bonds roll off the balance sheet without replacement was a form of tightening. So ending runoff represents a directional pivot. It's a move back toward what central banks call normalization. And in modern finance, normalization has a very specific track record. It tends to mean easier conditions over time. It tends to mean rate cuts show up faster than people initially expect. And it tends to mean the moment something breaks in the financial system, the response is more liquidity, not less. Now, stopping runoff is not the same as immediate money printing, but it removes a structural headwind. It shifts the stance from tightening to neutral or accommodative. And precious metals don't need perfect conditions. They just need the marginal change to favor scarcity over paper assets. On top of the balance sheet shift, policymakers have been signaling that interest rates are likely to move lower through 2026. Even if those forecasts shift based on data, the directional message is clear. The peak is behind us. Why does that matter for silver? Because lower rates reduce the opportunity cost of holding metals. When treasury yields are high, there's a real cost to holding silver instead of bonds. You're giving up that yield, but when rates fall, that opportunity cost shrinks. Lower rates also tend to pressure real yields, which is nominal yield minus inflation. And when real yields fall or go negative, scarce assets tend to reprice upward. But here's the bigger strategic point. Debt levels are historically high across developed economies, and economic systems are sensitive to rate changes in ways they weren't decades ago. That means central banks face political and economic pressure to choose stability over tightness. So if you're looking at 2026, you have to ask yourself, do you really expect policymakers to stay restrictive the entire time? Or do you expect the usual pattern where something cracks, markets wobble, and the response is immediate easing? If easing shows up, and history suggests it will, silver tends to respond aggressively. Why? Because it's a smaller market than gold or equities. Capital flows move it faster, and once momentum builds, the moves can be explosive. Monetary policy might seem abstract compared to supply deficits or export controls, but it's the accelerant. It's what turns fundamental tightness into price momentum. Now we get to reason number 5, volatility. And I want to be precise about this. Volatility isn't a reason silver goes up. Volatility is how silver moves. It's the mechanism by which metal transfers from weak hands to strong hands. It's how silver punishes impatience and rewards those who understand what they're watching. And volatility doesn't just happen over time. It can happen across geography. Late 2025 gave us a perfect example. We saw an unusually large premium open up between pricing in Shanghai and pricing in Western venues like COMEX. Historically, when spreads get too wide, arbitrage traders close the gap. They buy where it's cheap, sell where it's expensive, and pocket the difference. But when the gap expands to $6 and in some reports even wider, it tells you the pipes are clogged. Moving metal isn't frictionless anymore. Physical delivery matters, settlement matters, and that creates an incentive to pull metal from where it's cheaper to where it's more valuable. But incentives don't equal easy execution. There are shipping constraints, timing constraints, settlement constraints, and if those frictions persist, spreads can stay wide far longer than people expect. Now, this isn't just theoretical. There were reports of real buyers approaching a silver producer and offering to pay well above prevailing market price for physical metal. First offers were roughly $8 above spot. Then higher offers showed up, including one reported around $10 above spot. And what makes that compelling isn't just the premium, it's who was bidding. One buyer type was manufacturing, another was trading firms. A manufacturer bidding up supply says, I need this to operate. A trader bidding up supply says, this market is structurally mispriced and I can profit from that dislocation. When you see both buyer types competing at premium prices, you're seeing necessity and speculation stacking together. And that's when volatility expands dramatically. Let me show you how extreme the positioning swings can get. Even in leveraged products designed to bet against silver, we saw violent flow reversals. There was a single day that recorded the largest inflow on record into a double leveraged short silver ETF. That's bearish positioning at maximum conviction. Then, almost immediately, we saw the largest outflow on record from that same product. That's not calm conviction, that's panic, that's whiplash, that's forced exits and capitulation. It's volatility inside volatility. And this is why I keep emphasizing to people, if you're going to watch silver in 2026, you need a plan that survives noise. Because silver will absolutely try to scare you out. It will rip higher, it will dip hard, and it will do both on days when the headlines are screaming the loudest. Now, speaking of headlines, let's talk about narrative management. Whenever a market has real underlying fundamentals, you see a predictable pattern of commentary. You see a wave of stories saying it's over. You see warnings of imminent crashes. You see voices saying sell now because this time is different. Except the message is always the same. Get out before the next move. And sometimes, yes, silver pulls back. It's a volatile metal. Pullbacks happen. But the bigger question is whether the underlying constraints are easing. Is the structural deficit ending? Are governments suddenly less interested in strategic reserves? Is fiscal urgency disappearing? Are export controls reversing? Is monetary policy getting significantly tighter and staying that way? If the answers are no, then the pullbacks are part of the process, not the end of the story. Volatility is the price of admission. And in silver, volatility rewards those who prepare for it instead of reacting to it. Alright, now let's connect all of this into a coherent picture for 2026. Here's what the market is setting up. Silver is coming off a year where performance forced mainstream attention. Supply has been lagging demand for years, which means the inventory buffer is demonstrably thinner. Governments are treating silver as more strategic, which can trap supply inside national borders. The futures curve showed stress signals consistent with physical tightness and urgent demand. Central bank policy has pivoted away from maximum restrictiveness and toward accommodative conditions. And global price dislocations are proving that physical premiums aren't hypothetical. They're real, they're wide, and they're persistent. That's a dangerous combination for anyone trying to wait for a perfect entry. Because many of the best silver moves happen when the entry looks worst. They happen when the chart looks extended, when premiums look annoying, when mainstream voices tell you the trade is crowded. Then the next leg hits, and everyone who waited ends up buying higher. Now, does that mean silver goes up in a straight line through 26? Absolutely not. And if you need a straight line, silver is not your market. Silver is a staircase with broken steps. It climbs, drops, then suddenly jumps. That's why 2026 has the potential to be a viral story. Because the moves can be shocking. And shocking moves create attention. Attention brings in new buyers. New buyers tighten the physical side. And tighter physical conditions feed right back into backwardation and premiums. That's the loop. Now I want to hear from you. I'm genuinely interested in your perspective on two questions. First, what do you think becomes the dominant driver in 2026? Industrial demand or investment demand? Because if industrial demand continues accelerating, especially from solar and electronics, that's consumption that doesn't come back to market. But if investment demand surges, that's capital flows that can move fast and create momentum. Both matter. But which one do you think leads? Second question, if the East-West premium stays wide, what breaks first? Paper pricing confidence or the willingness of physical holders to sell? Because if physical holders refuse to sell at paper prices, eventually paper prices have to adjust upward. But if confidence in paper pricing breaks, you could see a rush to physical that overwhelms the system. One final reminder before you go. If you want to stay ahead of the story as it develops, subscribe to this channel right now. Short and simple, one tap. Because the biggest mistake people make in markets like silver is they show up after the move when risk is higher and upside is smaller. The opportunity in 2026 isn't about predicting exact prices, it's about understanding the structure. It's about recognizing when fundamentals and mechanics align. And it's about having a framework that survives volatility instead of getting destroyed by it. I'm wishing you a strong week ahead. Take care of yourselves. Take care of each other. And I'll see you in the next video. Remember, volatility is the price of admission. And in 2026, silver is going to charge full price.